Hey everyone, it's Mrs. Austin, your favorite accounting teacher, and I'm here to help you through the Work Together 2-2, just in case you need a little assistance. So I'm going to go ahead and hide this nonsense out of the way. All right, so I'm going to go through this with you quickly so that you kind of understand what's going on. I'm in the question assets box here, and these are the account titles of all the accounts that are going to be, I guess, that we're going to use in the transactions, okay? Some of these might not be completely familiar to you yet. We're going to go over more of these accounts in section 2-3, but we have cash, accounts receivable, supplies, and insurance. We know those are assets. The account payable, we know is a liability. The owner's capital and drawing account are owner's equity accounts. And then we have sales and a couple of expense accounts. So we have a few transactions, 5 transactions that are going to be placed into T accounts, okay? So the name of the business is Jensen Cleaning Service. They use the accounts that we just went over. We're going to prepare 2 T accounts for each transaction because each transaction affects 2 accounts. Remember, double entry accounting. One is going to be a debit and the other is going to be a credit all the time. Debits and credits have to equal. Debits equal credits. You have to say that to yourself a million times so that you remember it. Debits equal credits is the same as the accounting equation being in balance. Assets equals liabilities plus owner's equity. Everything has to be in balance all the time. If it's not, then somewhere you made a mistake and you have to find it. All right, so let's do the first transaction together so you kind of get an idea of how this looks. So received cash from owner as an investment, $4,000. We've seen that transaction before. That means the owner is investing their personal money into the business as an investment. So the 2 accounts affected are cash and the owner's equity account, the owner's capital account. So let's pick those account titles. So cash would be 1. And let's pick John Jensen Capital account because that's the account that's going to be affected along with cash in this transaction. So if you're receiving cash, $4,000, cash is an asset that is on the left side of the equation, which means this account increases on the left side. So it's going to be a $4,000 debit entry, okay? And the capital account is going to increase. Owner's equity goes up when there's an investment. Capital accounts, owner's equity, are on the right side of the equation, which means it's going to increase on the right side with a credit entry. And if our transaction stopped right there, the accounting equation would be in balance. Okay? All right, let's do the second one. I'm moving down. I need to read it. Number 3, paid cash for supplies. Paid cash for supplies, $95. That's one of those transactions where the increase and the decrease, the debit and the credit, are going to occur on one side of the equation. Okay, so if you're paying, so let's see. The 2 accounts are cash and supplies. So let's pick that first. So let's pick supplies because cash is not an option. So we'll choose supplies. And cash is the second one. So if you bought supplies with cash, says you paid cash for supplies, you're buying supplies, so supplies increases, and supplies increases with a debit entry because supplies is an asset. Assets are on left side of the equation. They increase with a debit entry. Now, cash is also an asset, but you just paid $95, so your cash is going down. Even though cash is an asset and assets are on the left side of the equation, assets only increase on the left side of the equation, which means they decrease on the right side of the equation, which is where the credits are. Credits are on the right. Okay, so cash decreases with a $95 credit entry, and your equation is still in balance. Okay. The fourth, bought supplies on account from Supply Depot, $120. So supplies and Supply Depot is going to be they're going to be our 2 accounts. All right, $120 is the amount, so we'll have to remember that. So let's choose our accounts, supplies, and accounts payable, Supply Depot. How much was the money? I already forget. $120. So supplies increases, 120, and accounts payable is a liability that also increases, and that's a credit entry. okay? I want you to notice a couple of things here so far. We've done 3 transactions. The first part of every single transaction is a debit. Debit, debit, okay? So when you go to choose the account title and you don't see an account that you're looking for, like this first one on March 3rd here, we didn't see cash. The reason for that is supplies was the only other option to choose, and supplies is entered first because it's the debit part of the transaction. This is one of those things that when we get to the general journal in chapter 3, you'll see why the debit portion is always entered first, okay? Mathematically, it wouldn't matter, but it keeps the information organized and straight if you use the debit, if you put a debit part first, okay? I know I'm getting off track, so I need to stop. But so for March 4th, supplies is an asset, increases on the left side, which are debits, 120. Accounts payable, liability, on the right side of the equation, they increase with credits, 120 credit, okay? All right, so March 6th, paid cash for insurance, $250. Paid cash for insurance, cash and insurance are our 2 accounts, and you're going to notice that you're not going to have cash as a choice here. You have insurance as a choice because insurance is going to be the debit part of that transaction. What was it? Did we say 250? And then the other account is cash. Cash goes down with a credit entry. So insurance goes up with a debit entry, cash goes down with a credit entry. Okay? I think it was 250. All right. And the last one, paid cash on account to Supply Depot, $80. Okay, so cash and Supply Depot are your choices there, but you're only going to have one available to you for the debit part, and it's going to be Supply Depot because cash is decreasing in this example, and cash is going to have a credit part entry. All right, I already forget what the money amount was. Oh, $80, okay. So the liability is going to decrease with a debit entry, and cash is going to decrease with a credit entry. Let me explain that one because that might be confusing to you. Accounts payables are liabilities. Liabilities increase on the credit side, so that means they decrease on the debit side. Okay? Cash is an asset. Assets are on the left side of the equation, which means they increase on the left side. In this transaction, cash is decreasing, so that's why it decreases on the right side, on the credit side this time. Okay, I'm going to stop there and you can clear your head before going to the next one.